Hey guys, so currently I'm parking 138K in J AAA, and it generates about 500 plus in monthly income. Distribution slightly declined this last month down to 18 cents, and I'm thinking about dumping out because if the Fed fund rate goes down in the future, so will the yield I'll get on J AAA. So I've got to come up with a strategy. So I decided, well, I'm not going to buy my favorite holdings, my dividend payers yet, because I want a substantial discount. However, I do options. So if the options I'm looking at three ETS, Granny, BTCI, and IVES. And they're fairly liquid, not extremely liquid, but they're somewhat liquid with options. So I decided that because of that income represents 138K, I could do as many as 7 contracts per month, and that would use about a 19,400 in leverage on that 138K, and I'd be able to average down a total of 7 times if I'm in premature and we get a market pullback. So I'd be able to average out my cost basis using options, selling puts, and on the return side of it later on sell call options or just do the capital appreciation side of things. Then I thought, well, what if the market really pulls back, right? And I'm tied up in all these contracts I did, and I'd be doing it over the course of each month. So basically, I would catch a decline in the market by selling out of the money puts, and the market declining, I'd get more money on the puts. So all this that you see here, as far as the figures, would change. The amount of leverage would change because my puts could be further out of the money, or further toward whatever the share price is at during a pullback even, and I could actually get more premium with a lesser amount of leverage. So my goal is 500 plus in monthly income. So I do 7 of these contracts a month, leveraging initially 19,400 bucks, but that would change if there's a decline in the market. I'd be leveraging less money and probably even getting more income if there's a significant decline in these holdings, right? So the idea is on Granny, I do 3 contracts per month. On IVES, I do 3 contracts a month. On BTCI, because relative to Bitcoin is more volatile, I do 1 contract a month out to the max expiration. And if you take that figure of 10.50, you multiply that by 100, that's over $1,000 for what it recently paid for that put at a 35 strike. Now, this is all changeable because if the market goes up and volatility goes down, these contracts I would have to chase at the money initially and then later on turn around and sell puts during a decline. And so the ability to average down 7 times over puts me in a good catalyst to where if I get a sign, some of my puts won't even ever get assigned later on as I'm rotating each month. But as I get a sign and it rebounds, I rebound on share price and sell covered calls or whatever I want to do, or sell out of the shares and rotate. So that's my mindset going forward because J AAA, it's a dividend income might decline. It might come down to share price a little bit, not by much. J AAA is pretty steady in that regard, but I'm thinking about generating income just with options by doing something like a will, like not a complete will, because I don't believe in selling out of things necessarily if they're declined. I think even if they're at your cost basis, if they're growth um, equities, like these are regarding growth equities, I'd basically just hold on them until they bounce or average down, then consider selling out at covered calls if the market seems flat. Outside of that, I'd be managing what I do. There'd be some months I may not derive any income because I'm managing the strategy. So the thing is, it would tie up income, right? So if there's a decline in the market, what am I going to do about a good 20-30% base decline? And I want to rotate when these are down, or I mean at break even, and I don't want to rotate at break even. I want to see that growth, right? I would just keep the shares, whatever I'm assigned with. And then I would use whatever available cash that I derive from option income or my other dividend income to buy the dip in my favorite holdings. So what are my favorite holdings that I would go into aggressively. Well, one of them is QQQI, and you can see how it's performed its metrics. The assets under management is 8.39 billion. Average daily volume on it 6.18 million shares traded per day. Analyzed distribution yield of 14.3%. 1 year total return of over 17% with expense ratio of 0.68. So I love QQQI. Has fantastic stability. Unlike funds like QYLD, it didn't suffer from such a NAV erosion. Of course, it hadn't been around that long either. But if you look at the 52-week range of 41.17 to 55.93, it's pretty close to the top part of that range. If you look at the monthly payout, it's consistently over 60 cents, 60 to 65 cents a month per month. The biggest drawdown was 20%, which it's recovered almost. It had recovered fully from that. It's slightly down from its high, but it had recovered all the way up to $55 at one time. Total return with dividends reinvested since inception of January 2024 is 41.7%. Analyze that out. That's a 19.8% per year return. Pretty decent. Outperforming other firms. You notice the note on there, it's outperforming JEPQ or other peers. So also there's a tax efficiency with it too, because they do Section 1256 contracts on the indexes. So 60% of your gains are taxed at a lower long-term capital gains rate, and 40% is at short-term rates. The other fund is SPY-I. So that's my top two funds, QQQI and SPY-I. SPY-I with assets under management of 7.74 billion. Average daily volume, 4.51 million shares traded per day. Distribution yield, 11.7 to 12.2%. Basically, 1 year total return of 15.5%. Expense ratio of 0.68. And really decent NAV stability, a 52-week trading range of 41.60 to 53.38. Current share price is at 52.75. Pretty stable fund. They use a call spread strategy rather than doing just covered calls. They allow some, they're managed really well. They allow some uptick during a sell-off. If it looks like the market's going to recover, they'll lessen how many options they do. So that's what I like about the fund, because it's managed really well. The monthly payout on SPY-I, the recent distribution was 53 cents. The range is 50 to 54 cents per share over the last 12 months. Now, since inception, this fund has had an analyzed return of roughly 14.8%, outperforming the standard S&P 500 buy right index. So this fund's doing really great too. And it's more diversified than what you got with QQQI, because it's based on the S&P 500, and it utilizes the same 1256 tax advantage contracts. So that's what I'm considering doing in the future, is moving money into option strategy, and then using the covered calls, selling shares and whatever else, and dividend income to buy the dip in both SPY-I and QQQI, and make them basically my primary holdings. But I look for growth areas for doing options, but I want diversity, so I chose, really my two prime ones will be Granny, the Granny ETF, and IVES, the IVES ETF. They're both exchange traded funds, and that's what call options are going for currently on those two funds. I just did an IVES put, and I closed it for a profit overnight. I'm probably going to get back into it and start selling more puts on it, and replacing that JAAA income of 500 plus per month that I'm getting, but I'm leveraging 138K on it, and I start selling puts on both IVES and Granny aggressively, 3 each per month, and then BTCI, just 1 contract per month. And what I would do is I would go a little bit longer than 30 days. So obviously I'm not going to get exactly 500 a month. Sometimes I might get more, because I'm waiting to see what happens with the market and the contracts themselves. At times, if they're like 30% profitable, might just close them out and then wait for a pullback and resell them. I do stuff like that all the time. Like I did one with IVES overnight, where I was profitable overnight and closed it out for a gain. So I want stuff that I know is going to rebound for the most part. So IVES and Granny are my top 2 choices for that. And if you want to look at IVES or Granny, I'll do separate videos later on to show you the holdings of each one of those. BTCI is directly correlated to the price action of Bitcoin. So that one I'm going to be a little bit more risk off, just sell one contract per month on it. Anyway, that's a strategy I'm thinking of doing, how I'm going to rotate doing options instead of like holding a bunch of money in JAAA in the future. All right, guys, take care.